Honestly, it was like so like $15 one day. Man, you should come run it now. Like when or like with the volleyball, yeah, we good. That's good. He doesn't appreciate my job. They was like, remember Chad and Nita? Like I stayed with us. Were you there when he stayed?
Okay, folks, couple of things. One is, I think I've returned every DCF in my smart folder back to you, the smart folder being anything that has the title My Perfect DCF. So if you haven't got it back, unless you sent it today, today's DCFs, I haven't returned it. I haven't had a chance to look at them. You should have them back. If you don't have them back, it's probably because you tried to be clever on the title, like My Imperfect DCF. Doesn't work. Computer doesn't see it. So computers have no sense of humor, no subtle thinking. So don't try to be clever. Just put My Perfect DCF. It'll go to the right folder and I'll get it back to you. So most of you got your DCFs back, right? You got a value for your company. What's your next item on the agenda for the project? You have to price the company. I'm going to lay the foundations for something that some of you will face once you price the company. And I'll do a hypothetical. Let's suppose I do an intrinsic valuation of a company and I come up with $10 per share, DCF value. Stock is trading at 15. If I stop there, you say stock is overvalued. But I go out and price the company. These PE ratios and comparable firms. And I come up with a pricing of $20 based on how comparable firms are priced. So market price is at 15, my intrinsic value is 10, my pricing for the company yields 20. So I'm in a bit of a quandary here. So I'm going to read out this, some conclusions, and you tell me which one of these you would attach yourself to. Would you tell me the stock is undervalued? Technically, your intrinsic value is lower than the price. It's not undervalued, it's overvalued. So the pricing is higher than the value, right? Is it overvalued? Well, intrinsic value just suggests it's overvalued, but then you got this pricing number hanging out there. Is it correctly valued? I'll tell you the logic for that. Your intrinsic value was 10, your pricing was 20. What happens if you add the two numbers and divide by 2? You come up with 15. You see, that's magical. My stock is correctly priced. Or maybe this statement is going to sound absurd. Maybe it's both overvalued and undervalued at the same time. Could something be both over and undervalued? In other words, if I asked you to summarize, and this is not going to be unique. For many of you, this is going to be the case where your DCF value is lower than the price and your pricing yields a number higher than the price. You'll have to conclude in your last paragraph what you think about your company. I want you to tell me how you would conclude, what your conclusion would be on the company. How would you describe your findings? Anybody want to try? It's overvalued. I don't think there's any question. And it's underpriced. And I think that I want you to start thinking about those words, because when you use pricing, you're doing, and you're saying, how can the two be true? Because you're asking two different questions, right? When you're doing intrinsic valuation, what's the question you're asking? Given the business, given the cash flows, growth and risk, is this company a good bargain? And the answer is no. In pricing, what's the question you're asking? Given what people are paying for other companies just like this, is it a bargain? And the answer could be yes. You're saying, why can't I just average the two and say it's fairly priced? I see bankers do this all the time. They do an IPO, they do a pricing, a PE ratio, and then a DCF, then add the two numbers up and say, that's like saying you'll be a Buddhist for the first half of the day and a Muslim for the second half of the day. It's not going to work well for you. Because you can't, there are two different ways, two different philosophies. You can't split the difference. Let's keep going. When you say you price something, remember it's a conditional statement. You know what I mean? You price something by looking at other things like it. Let's say I take this company that I just priced in the previous page, and I reprice it. You're saying, how can you reprice it? Well, I can price it against the entire market. Remember, depending on what I compare my company to, I can arrive at different prices. Who's clearing their throat? Could you please mute yourself? So if I price it against the entire market, let's say I get $10. I'm back to my DCF valuation. Now I've got two different pricings for my company. I'm saying it's both underpriced and overpriced. And how would I resolve that difference? Depends on who I compare the company to. I think I've used this analogy before, but I'll use it again. If I ask you, are you a tall person or a short person? You can do an intrinsic measurement and say, I'm 5'7". I am kind of a short person. But let's say I put you in a room of people and saying, relative to the people in this room, are you short or tall? Depends on which room I put you in. If I put you in a room of professional basketball players, you're going to say, I'm tiny. I put in a room of jockeys. Remember, if you're a jockey, Shaquille O'Neal would not be a good jockey. Can you imagine the poor horse on which Shaquille O'Neal sits? This is not going to race. He'll just sit down saying, I can't carry this guy. It's 300 pounds. I think the median height for a jockey is like 5 feet 1 inch. So basically, if you're 5'7", you're tall. You see where I'm going? Based on who I compare a company to, I can come up with very different conclusions. So I'm preparing you for what you will find in your pricing. Don't expect it to be what you found in your DCF because you're asking a very different question. So let's go back because today we're going to have some fun. We've laid the foundation for pricing. So we're ready to actually ask. So we're ready to have some fun. Here's what I'm going to do. I'm going to play the role of an equity research analyst. I think I'm going to be equity research analyst in 8 different sectors. Why? Because I keep getting fired because I send out all these bad recommendations. So here's what I want to do. As I put a recommendation out, I want you to ask me the right questions. Tell me what I'm missing. So let's start easy. I'm the beverage analyst. I cover beverage companies. This is my sector. I have the PE ratios for the companies. I've got growth and risk. And you say, why is it there? File it away for the moment. I'm going to play the role of a naive analyst and put out buy recommendations on 3 of these 5 companies. Todd Hunter, I don't even know what they do, probably produce something that nobody should be drinking in the first place. Andre Wine, have you heard of these? These guys make champagne that's so cheap, I think you get a headache just watching the commercial for the champagne. And Hanson Natural. You see why I picked those 3? Those are the 3 companies that traded less than 10 times earnings. So I'm a naive analyst, I'm saying lowest PE ratio. But I've kind of given you the reasons why they look cheap right on this page, right? Why are Andre Wine and Todd Hunter why do they look so cheap? What is it about them that, remember I said most companies that look cheap, there's a reason for them being cheap. For those 2 companies, what's the big reason? Take a look at the growth rate. They're the lowest growth companies. You see, what about Hanson? It looks pretty good. There's one weak link in the Hanson story, which is we look at their standard deviation, the riskiest company. I'm not trying to explain away the pricing, but I'm saying there's a good reason these companies look cheap. 2 of them have the lowest growth rates in the sector, and the other one is the riskiest stock in the sector. Now you can see why I got fired. After I put those buy recommendations, investors pointed out, these are not cheap. These are low growth or risky companies. But I land on my feet. My second sector that I'm in is the telecom sector. And at least initially, it's telecom ADRs. Let me back up. Until probably 1990, 1985 or so, outside of the US, telecom companies were government owned. US, of course, had regulated monopolies. AT&T was the monopoly. It was a publicly traded company. But much of the rest of the world, the government owned the telecom company. Starting in the 1980s, you started to see privatizations where governments took these companies that were government owned, made them into public companies. So now you have these global telecom companies, and many of them wanted a listing in the US because you could raise more capital. And the way a foreign company gets listed in the US is it has to list what are called ADRs, depository receipts, which are denominated in dollars, and the company is required to restate all its financials using GAAP rules. The nice thing about that, the per share, at least in theory numbers, the earnings should be measured the same way across the companies. So the late 1990s, those are my telecom ADRs. There's the PE ratio. I'm the naive analyst in this sector, and I put out buy recommendations on two companies. Guess which two? Indosat and Telebras, right? They said they look cheap. Pushback. What's the first pushback I'm going to give? I've given you some ammunition on the growth, right? They look like they're lower growth companies. What's the other thing that should worry you? You know what Telebras was? It was the Brazilian telecom company in the late 90s. It's since been broken up into 6 or 7. It was the government-owned Brazilian telecom company that was now, so it was in Brazil. Indosat was the Indonesian telecom company. And these were the 1990s, where emerging market companies were emerging market companies, really risky, and developed market companies were viewed as safe. So there are two things that should worry you. One is low growth, and the other is that these two companies are coming from very risky emerging markets. You see, the problem with, on the one hand, on the other hand, is I could talk myself into a corner, and I don't want to do that. So here's what I did. I went back to that tool I used last class, a multiple regression. I took the PE ratio as my dependent variable, and I had two independent variables. One was the growth rate. Why? Because higher growth companies should have higher PE ratios. The second is I'm worried about a company being in an emerging or a developed market. Now I could go look up country risk premiums for each country, but I was too lazy. So what I created was what's called a dummy variable. You know what a dummy variable is? It takes on a value of either 0 or 1. And here's what I did. It was an emerging market telecom company, I put 1. So developed market telecom company, I put 0. So think of the Excel spreadsheet. Our PE ratios in the first column, growth rates in the second column, and the 0, 1 variable in the third column. I ran the regression. First thing that I looked at was the R squared. Nice, 66%. It's not 90%, which is what you see in statistics classes, but nothing worth testing ever has an R squared of 90%. 66% I can live with it. Let's break it down. The constant, the base from which I'm going to build off, the intercept is 13.12. What does that tell me? Not much. It's telling me something about the overall PE ratio in this sector. That I'm going to start with that base. Every 1% increase in my growth rate increases my PE ratio by 1.2. What does that mean? If you're a telecom company with a growth rate 5% higher than mine, your PE ratio is going to be roughly 6 higher than mine, 5 times 1.2. I've quantified. So now I'm not just waving my hands and saying higher growth means higher PE. I'm saying exactly how much higher. But to me, the most fascinating coefficient is what you see on the emerging market dummy, minus 13.85. See, what does that even mean? I have two telecom companies with the same growth rates. One is a developed market telecom company, the other is an emerging market telecom company. You know what this regression is telling me? That the emerging market telecoms company's PE ratio will be 13.85 lower than the developed market telecom company. Remember when we did discounted cash flow valuation, how we dealt with country risk? We did this elaborate dance, right? We measured country risk premiums, we added them on, came up with the cost of capital. In pricing, we're just taking a much simpler tack. We're saying, let's let the market tell us how risky emerging markets are by seeing how much lower PE ratios are there. But why did I embark on this mission? Because I started with this recommendation of Telebras looking cheap. Now I have a regression. Here's what I did. I went in and plugged in Telebras's growth rate and the fact that it's an emerging market company into that regression. I get a predicted PE of 8.35. What does that mean? given the low growth and the high risk at Telebrás, this is the PE ratio I should expect to see. It looked cheap at 8.9 times earnings, but guess what? Relative to that adjusted PE ratio, it's actually expensive. It's a risk-adjusted, growth-adjusted prediction, and I can compare that to the actual PE. Again, not rocket science. I've just brought in statistics to control for those differences. I can do the same thing for Indosat. I think it too looks expensive once you control for the low growth and the high risk. And I can go through every company in that group and tell you which companies are cheap and which are expensive. And because it's surprising, roughly half of all companies are going to come out as cheap and half are going to come out as expensive. So now I'm fired as the emerging market telecom analyst. But I always land on my feet. I've now become the European banking analyst. In 2010, I pulled up a bunch of European banks. There's a price to book ratios for each bank. Again, I'm going to play the role of a naive banking analyst. I never let go of the naive, which failed me previously, but I hold on to it. Guess which stocks I recommend? The banks with the lowest price to book ratios. There's Commerce Bank, there's Bayerische Hypo, which is probably some German bank. There's Deutsche Bank. They all look cheap, low price to book ratios. But notice that if you look at the low price to book ratio banks, they tend to have low returns on equity, and the high price to book stocks have high returns on equity. So already you can see the risk of going and buying the lowest price to book stocks is I'm going to get a lot of horrifically bad banks in my portfolio. So what's a mismatch I'm looking for? Price to book. What do I want to see in my cheap stocks? I want low price to book. I want high return on equity and potentially low risk, right? Now, I'll give you a very simplistic way you can make that judgment. See this bottom line here? I've got a median number for each of these values. So when I say low price to book, what's a very simplistic way of looking for low? Any stock that trades at a price to book below the median, 2.07, is on the low end. Any stock which has a return on equity greater than 11.82% as a high return equity, and any stock with a standard deviation less than 21.93% is a safe. So you want to find a bank that trades at a price to book ratio lower than the median, has a return on equity higher than the median, and a standard deviation lower than the median. Let's at least eyeball the data. It's going to be very messy. So let's start with anything below 2.09. So it's those companies. The only company with a return on equity higher than the median is Paribas, 12.46. But its standard deviation. So it meets 2 out of the 3. But there isn't a single bank that meets all 3. You can try for overvalued, right? Overvalued would be banks that traded a price to book ratio higher than the median, a return on equity lower than the median, and a standard deviation higher. I think the bank that I think comes closest again, I think might be Erste. It trades a price to book ratio higher than the median, return equity lower than the median, but its standard deviation is almost at the median. There are no obviously completely mispriced banks, but you can see that by comparing the median, at least you can start refining your search, saying these are the most interesting companies. The problem though is, let's say your sample size was 80 and you had 4 variables to control for. You're going to go dizzy trying to eyeball the data and try to find things. And here again, the advantage of a regression is it can bring it all together in one place. So here's what I did. I took the price to book ratios to these banks and ran a regression against return on equity and standard deviation. Let's read the output and see if it makes sense. There's a starting point, 2.27. Not much you can take out of that. Higher return on equity. Banks have higher price to book ratios. In fact, every 1% increase in the return on equity pushes up the price to book ratio by 0.0363. Higher risk banks have lower price to book ratios. And incidentally, I use standard deviation as my proxy for risk, but this is pricing. What's a more, I think, more reasonable way when you think about a risky bank? What is usually the metric that leads you to tag a bank as risky? What makes a bank risky? Usually you don't look at standard deviation, right? From an intuitive standpoint. You look at something like, do they have enough regulatory capital to keep going? You look at their regulatory capital ratios. In fact, I could replace the standard deviation by tier 1 capital ratios, which are an S&P Capital IQ. And I say, I want a bank with a low price to book, a high return on equity, and a high tier 1 capital ratio. That's the mismatch I'm looking for. In fact, since I had the regression, I used it to get predicted price to book ratios for every one of my banks. So if you look at Bayerische Hypo, the German bank that looked cheapest, it does look cheap even after I've adjusted for its predicted price to book is 0.89, it's trading at 0.80. I do this for every bank. And if I'm the banking analyst, then I focus in on the cheapest and the most, it's not like I'm replacing myself with a regression, but it's one more tool in my arsenal to control for differences across banks. Any questions on the Euro banks? So now I'm fired as the European banking analyst because I made you buy whatever, bearish. Yes.
Does this method account for if a bank is heavily doing investment management, brokerage?
The regression accounts for whatever you make it account for. So if you're worried about that mix, what do you need to add? Add a fourth column, and the fourth column will be the percentage of revenues of the bank that comes from investment banks, right? You have to be, when you use data, here's the one thing you have to do. You have to leave your ego outside the door because the data is going to tell you what matters, what doesn't. Don't fight the data. This is something you're going to see me email you over and over again, because when you fight the data, you always lose. So you might say that should matter, but you know what? That and $2.50 might get you a cup of coffee. I used to say $1, but that doesn't work in New York anymore. But what you think, what I think, what the theory thinks is kind of irrelevant. It's what the market thinks that you're trying to reflect in the pricing. So now let's move forward to a much bigger sample. Rather than look at a sector, what if I took the 100 largest market cap companies in the US and I said, I want to buy the cheapest companies in the market. So these are big companies specified in terms of market cap. So this was in January 2010. I took the price to book ratios for each of these companies and the returns on equity for each of these companies. This is actually a 5-minute job because basically I just downloaded price, book value, and net income for every company from S&P Capital IQ, and then computed the price to book and return equity. And then you can do a scatterplot with an Excel. So you know what a scatterplot is, right? A price to book against return equity. Each of these points is one item in my sample. So if JP Morgan has a price to book of 1.6 and a return equity of 15%, I plot JP Morgan. So if you wanted to and you counted these points, there should be 100 points in there. Saying, what are these lines? The middle line is a best fit line. In fact, most regression packages, I don't know whether Excel allows you to do it. If you do a scatter plot, it'll ask you, do you want me to fit a best fit line? It's like a regression line. That's what it is. That's a middle line. You're saying, what are these two outside lines? When you do a best fit line, there's a standard error around it. Those outer lines are the 90% confidence intervals. So I'll start with the unexceptional news. Most companies are within the bounds of what you think of as fairly priced. So fall between the two lines. So let me ask you a question. Where on this graph would I find my overpriced companies? So I've got everything that falls within those two lines. Where in this chart would I find my overpriced companies? The companies fall above the top line or below the bottom line? It's going to be above the top line. I list out the 3 companies that came out as looking overpriced, and you tell me whether they share anything in common. One was Google. Google circa 2010. The second is, I think that's Infosys, and the third is Gilead, which at that time was a young growth pharmaceutical company. So what do they share in common? They all have high growth. When I take price to book against return equity, remember when we looked at the price to book ratio for a company, we said it is a function of return equity, but we also said it's a function of growth and risk, that high growth companies should have higher price to book ratios for a given return equity. So what this plot is saying is maybe these stocks are not overpriced, maybe you're just missing growth. How would I deal with that? This is a 2-dimensional scatter plot. What if I could bring in a 3rd dimension? A 3D scatter plot sounds kind of complicated. And I don't really like them because they make me dizzy. But think of it as an equivalent of having a cardboard box or a 3 dimensions. On one side, your PE, the second is growth, the third is return on equity. So let me ask you where in this box you'll find your cheap stock. So tell me the combination you're looking for a cheap stock. You want low price to book. You want high return equity or low return equity? High return equity. And you want high growth. So there are your cheap stock. There's actually nothing there. The closest I get is Time Warner. You're saying, why is there nothing there? What is my sample? 100 largest market cap companies in the world, right? It's very unlikely that you're going to see something so screwily priced that it's going to be, that can't happen. But if I did this for 100 smaller companies, under the radar companies, you don't know, markets could make mistakes. It could overlook things. That's price to book, and now I brought in growth. But risk is also a worry, right? And here's the problem, I can't do 4-dimensional graphs. So I went back and did another 3-dimensional graph. And this time I looked price to book, return equity, and I threw in beta as my proxy for risk. So I want low price to book, I want high return equity. Do I want low risk or high risk? I want low risk, so there's where I'm looking. The closest I get is ExxonMobil, but that's about all I can get. Here's the problem with charting. Unless you have something that is so outlandishly mispriced, you're going to say, look, that looks mispriced, but I don't know whether I'm going to act on it. So here again, I went back, and by now you can see why I keep going back to regressions. When I run a regression, I can have as many dimensions as I want. I'm not visually looking at it. I ran a regression of price to book against return on equity, beta, and growth. R squared is 66%. That's pretty impressive. 66% of the variation in price to book ratios across 100. Remember, they're in very different sectors. 66% of the variation is explained by beta, growth, and return equity. And in fact, if I look at the coefficients, it looks like beta doesn't even matter. At least for these 100 biggest companies, markets are not worrying about risk. When you get big enough, I guess, you're not going to be really incredibly risky or incredibly safe. The coefficient, if you look at the beta, the t statistic is minus 0.26, which is close to 0. I have some advice for you. When you run regressions and you get variables where the coefficient is not statistically significant, you know what you should do? Take it out of the regression. If you leave it in, it's just creating noise. Why add a variable in if it's not explaining anything? So if I really wanted to, I would take that beta out, rerun the regression with just, my R squares are going to be pretty close to what they were before. And I will now have a regression with 2 key variables, which I can then use to price every one of these 100 companies. Now, one more thing, if I go back to that original graph, there were 3 companies that came out as undervalued. Does anybody recognize the symbols for the 3 companies? What's XOM? That's ExxonMobil. COP is ConocoPhillips. Already your radar should start to quiver, saying, those are 2 out of my 3 companies are oil companies. Is there something going on in the oil sector that might explain why these companies are underpriced? And there was. And here's what was happening in 2010. It was a year where oil prices had collapsed. The market reflected that. But remember, net income that you use for return equity comes from 2009, where oil prices were high. You had high ROE and low price to book ratios. They looked cheap because it looked like the market was missing the fact, but the market was actually on track. It's the net income not being updated that was making these companies look cheap. What I'm trying to say is, you're not trying to explain away everything, but in a group like this, where you have 100 largest market cap companies, I'm going to start with the presumption that when I see something being significantly mispriced, it must be something I missed, rather than something, maybe at the end of the process, I might still end up buying ConocoPhillips and ExxonMobil, but I want to make sure I'm doing it for the right reasons. So I updated this Scatterplot. I actually do this at the start of every year. And again, it's a 5-minute job. That's a nice thing about pricing. You have access to a database, you download the data, you can create the charts, nothing else. It gives you a talking point. At the start of 2022, that's what the 100 largest market cap stocks in the US look like. Now, I'll list that. There's Uber among the 3 most overvalued stocks. It's not actually above the line, it's almost on the line, so pretty close to being overvalued. There's Marsh McLennan, which is a consulting firm, I think. It's and Equix, which I think has something to do with construction. So 3 very diverse companies. I don't know what their growth rates look like. Maybe that's a missing variable, but worth looking at. If you look at the most undervalued stocks, see that cluster down there? What's C? Does anybody know what C is the symbol for? That's Citigroup. GS, of course, is Goldman Sachs, and JPM is JP Morgan. 3 banks are clustered looking cheap. And again, the fact that they're all clustered in the same sector makes me think there's something happening in banking that I need to factor in. You read the earnings reports coming out for JP Morgan this morning. Last year was a high watermark for many of these banks. They were making a lot of money. This morning, JP Morgan reported 38% drop in earnings. Of course, they're blaming Russia. Come on, stop lying. Russia didn't happen till way in the quarter. But it means that maybe the market was prescient in saying that return on equity looks a little too high. But that's the nice thing about, and as I said, this is something you can do in 15 minutes, get a sense of the market. So if any of you have interviews with hedge funds or portfolio managers and you want to get a sense of what the market looks like, and you don't want to read, you don't want to spend 15 days reading about companies, do this quick and dirty scatter plot. It'll give you an amazing amount of talking points. At least know what the symbols stand for. Then they say, what's GS? And he says, I don't know, it must be some company out there. It doesn't really impress them. But at least focus on the companies that are at the ends of the scale. So you can talk about, hey, banks look cheap today, but this is why. Because that's what this chart tells you. Let's move on. I've been fired now as the market cap, the big company analyst. I'm now the trucking analyst. I'm really in the dregs of equity research. It's about as boring as you can get. So here's the sector, the trucking sector. And again, I'm going to pick a company to put a buy recommendation on. I start by looking at EV to EBITDA. Why? Because everybody else looks at it. So I've kind of translated EV to EBITDA. First company I look at is KLLM, but I have no idea what they do. I'm looking for a familiar name. Say, oh, Ryder, I've seen the trucks around. Let me put a buy recommendation on Ryder System. It trades at 2.8 times EBITDA. It looks cheap, right? So I'm going to give you a chance to ask me some questions about Ryder. It could be cheap. Let's put that as one possibility. But let's start with the first question you're going to ask me about Ryder that will allow you to decide whether it's really cheap or deserves to be cheap. What's your first question to me? You try. If you were asking me about Ryder, it looks cheap. We went through this list on Monday of the series of questions to ask about EV to EBITDA. Do you remember the questions? Yeah.
What's the tax rate?
What's the tax rate, right? Maybe Ryder is, no, I don't know, in some country which has an 80% tax rate and everybody else is in Ireland. Well, in this case, it's not the problem. They all pay roughly the same effective tax rate. So off the table. What's the next question? What's a growth rate, right? It could be a really low growth company in a sector, but these are all boring low growth companies. It's not the problem. You might ask, what about the cost of capital? Maybe Ryder is an Argentine company and everybody else is a US company, but that's not the case either. So what are you left with? Reinvestment, right? And here I have to tell you something about the trucking sector that makes it a little unique. Reinvestment in the trucking sector is you replace your entire fleet every 5, 6, 8 years. You don't do it gradually because there's economies of scale of doing it all at one go. So what's your last question going to be about Ryder? You're worried about potential reinvestment?
When are they going to update it?
Or how old is my fleet? Because if you ask them, when are you going to update it? They'll say sometime in the future, which is kind of a fuzzy answer. But if you ask me, how old is my fleet? There's no escape hatch there, right? Ryder had the oldest fleet in the grouping. You know why the market's worried, right? It looks cheap, but what's coming down the pike? 2 weeks after you buy the stock, thinking it's cheap, you're going to open up the Wall Street Journal and there's going to be an article that says, Ryder has raised $5 billion in capital to do what? Replace their entire fleet. Your enterprise value is going to jump by that $5 billion. Your EV to EBITDA that looked low is now going to go back towards or even above the industry average. The reason I emphasize that is I actually pulled this out of an equity research report where the analyst had put a buy recommendation on Ryder Systems, which I'm okay with. So I read the report and there wasn't a mention about the life of the fleet or reinvestment. I actually went and looked at the annual reports of these trucking companies and I was able to find the average life of the fleet for pretty much every one of them. This was like 45 minutes of research. That's what I meant about lazy pricing. If you're going to use a multiple, you need at least ask the right questions and go collect the data to make sure that you're not picking a company that looks cheap rather than one that is really cheap. We're almost towards the end. And for the next two examples, I'm going to use price to sales. I concede going back, I should have used EV to sales. But because our historical analyses, I use price to sales. I confess it's not consistent, but I stayed consistent how I define margin. Price to sales, the margin that I should use is net margin. And I picked another really boring sector, even more boring than trucking. You say, what could be more boring than trucking? Grocery stores. You know how incredibly boring they are? They're low growth, low margin businesses. It's a grind. So in 2007, I plotted out the price to sales ratios for grocery stores against net margins. You know what? Most of them look boring. They all fall along the line. But there's this one outlier. You know who that outlier was in 2007?
Whole Foods.
Whole Foods originally. And you could see why this completely threw off people, right? Whole Foods broke the mold. They were high margin. They went for high growth. They were selling organic food, but that showed up in the high margin. It looked massively overpriced. How overpriced? I ran a regression of price to sales against net margins in the sector, plugged in Whole Foods margin, which was higher than the rest of the sector. But the predicted price to sales ratio I got was way below their actual price to sales. It was massively overpriced. 2 years later, I went back and looked at the sector. This is 2009. Price to sales against same regression. Same. You see where Whole Foods falls now in this sample? It's definitely not up there. It's actually now the most overpriced stock in the sector. It went from being most underpriced in 2007 to most overpriced in 2009. And in fact, if you plug in the numbers, it's gone from being underpriced to overpriced. 2010, I went and looked at Whole Foods again. It's back to being above the line. It's almost like this is a manic depressive stock. You can't make up your mind. Are you cheap? Are you expensive? But does that surprise you? When you think about equity research analysts in grocery stores, they've never seen a company like Whole Foods before. They could figure out what to do with it because the multiples and the way they thought about these stocks didn't fit. So they kept overshooting and undershooting. Now, part of you saying that's a problem, right? I think of it as an opportunity. When you see a company that disrupts a business come in, I can almost guarantee you, analysts, imagine when Tesla first came in, an auto analyst had never seen something like this. You know how many years, they still can't figure out how to deal with Tesla, but they're getting better at it. Eventually, they figure it out. But if you wait till they figure it out to get in, you've missed your big period of opportunity. In fact, by 2015, Whole Foods had finally been figured out. You're saying that's terrible, my opportunity is gone. Hey, don't worry, there's always new opportunities popping up because there's a new kid in town in 2015 called Sprouts. Kind of a miniaturized version of Whole Foods, much smaller, different business model. So keep your eye on the disruptors in these businesses because they are going to be almost always mispriced because analysts have their existing mechanisms don't work well at pricing these companies. So a NEO will be mispriced. A Tesla will be mispriced. And because it's mispriced, you're going to see much bigger difference between the actual price and what you think the pricing should be. So let me close with one final example of the company. Remember the Amazon valuation I did? It was like 4 sessions ago, discounted cash flow valuation. Started the dark side. I think I valued Amazon at $35 per share at the start of 2000. The stock was trading at 84. And I think I was pretty clear that even though I wasn't short selling the stock, I felt pretty, I concluded the stock was overvalued. At about the same time, I decided to price Amazon. Very different task, right? What is pricing Amazon require? That I look at what people are paying for other .com stocks, and based on that, try to put a number on Amazon. So I decided I had to pick a multiple. And very quickly, I realized there's only one multiple I could pick, a revenue multiple. You know why? Because this is the .com sector in early 2000. Nobody was making money. There was no net income, no EBITDA, no EBIT, no book value. Almost by desperation, I looked at price to sales. And we know if you use price to sales, the companion variable is net margin. So I plotted the companies. Take a look at that graph. If I showed you that Scatterplot, what's your reaction? It looks like a shotgun blast, right? That doesn't look like, if you ask me, what's the pattern? There doesn't seem to be any. It's all over the place. But undaunted, I decided to try to fit a line through those points. It's a nice thing about having a regression package. It'll do whatever you ask it to do, no matter how unreasonable or stupid it is. It did. And here's what it told me. Price to sales ratio is 81.36. What does that tell you? That the starting point for these pricing was 81.36 times revenues. And every 1% increase in the net margin lowered my price to sales ratio. Think about that. You see, that makes no sense. But these were .com companies, and if they're losing money, that was somehow viewed not just as a badge of honor, but a sign that they had bigger ambitions. The R squared, 4%. What does that tell me? There's no way I can even use this regression. It's telling me nothing. I wasn't the least bit surprised, and here's why. If you bought a .com stock at the start of 2000, whatever your reasons was, were you ever buying a .com stock for how much money it made in 1999? Nobody does. You're buying it because it has growth potential. You're buying it because you think it'll survive. So I said, I have to reframe my thinking. I have to think like the market. I have to think like investors buying .com stocks. So I'll throw out 3 hypotheses to you about pricing, and you tell me whether these make sense. Because before you run a regression, you have to have some degree of hypothesis. Here's the first one. This is the multiple of revenues, right? If you have $1 million in revenues, many of these .com companies were tiny, trading at 100 times revenues is not a big deal. There's almost no revenues. As $1 million becomes $1 billion, it's going to get more difficult to maintain 100 times revenues because, so my first hypothesis is as revenues get larger, the price to sales ratio should come down. We file that away as my first hypothesis. Second one is higher growth companies should have higher price to sales ratios than lower growth companies. Obviously, the growth can't be in earnings because they're all losing money. It has to be in revenue. So if I gave you revenue growth, companies with high revenue growth should have higher price to sales ratios. Agree? Third, when you look at young companies losing money, you always worry about them failing. So if I can give you a proxy for failure risk, you should price companies with lower failure risk at a higher price to sales ratio than companies with a lower failure risk. And I struggle with how do you measure failure risk? You're saying, why don't you use bond ratings? There were no bond ratings. These companies had no bonds. And if you step back and think about it, with young companies, you know how they fail? They just run out of cash. That's the biggest. So my proxy for that is tell me how much cash you have. If you have a lot of cash, you can survive for the next 2 years. Your failure risk is small. So I ended up running a regression of price to sales against the level of revenues. Log revenues captures how much revenue you have. Remember, my hypothesis was the larger my revenues, the lower the price to sales. Well, the sign is right, but the T statistic is it's not there. It's not statistically significant. Revenue growth, higher price to sales makes sense. In fact, that's significant. And the more cash a company has as a percent of revenues, the greater the chance of surviving, the higher the price to sales ratio. What I'm effectively doing is almost looking at the market through the eyes of an investor and saying, what are investors thinking about when they price these companies and putting them into the regression? You cannot have content for traders. So no matter what you think about the people buying electric car companies, don't start with the presumption that they're stupid, that they randomly attach numbers to companies. They have their own way of thinking, and you almost have to frame that if you're going to try to price a company. Here's the advantage. Once I have the regression, I plugged in Amazon's numbers into the regression. its revenues, its margin, its growth, its cash. And I came up with a predicted price to sales ratio for Amazon, 30.4. It was actually trading at 25.6 times revenues. At exactly the same time, while I'm telling you Amazon is overvalued on my DCF, I'm telling you Amazon looks underpriced. You're saying, how can the two be right? I'm answering two different questions, right? Given what I think about Amazon as a business in 2000, I think $84 is too high a price. Given how the market is pricing other .com companies, Amazon looks like a bargain. And both those statements would have been right in hindsight. Because 1 year later, remember what happened to Amazon's stock price? It had dropped to level. It had dropped 80%. So there's my vindication for my DCF, but it dropped only 80%. You're saying, what do you mean only 80%? You know what happened to the rest of the .com sector? It was down 95%. That's all pricing tells you, right? Pricing basically says, if the sector drops, you bought the least overpriced stock in the sector, congratulations. It's the Achilles heel of pricing. You're not buying cheap or expensive, you're buying the least overpriced stock if you're in a sector where everything is overpriced. So that's the first thing you can try. If you're in a sector, some of you are valuing electric car companies, and you decide to take the electric car sector, the only electric car company making money, this is almost ironic, is Tesla. I never thought I'd live to say the day that Tesla is the only money-making company in the sector, but when it started, it was in the automobile sector. Now it's the electric car sector. It's your old man in town. It's a money-making company. Every other electric car loses money. I'll wager if you take EV to sales and margins, you're going to see no correlation. It's going to look like that scat. So you can try what I did with Amazon. Think about what is it that investors are looking for in an electric car company and try to put in the regression. But here's the second thing you can try. One of the problems with young companies that makes pricing so difficult is there's not much here now. You know what I mean by that? Your existing revenues are small, they're money-losing company. That's the problem we're running into when we use price earnings or EV to sales, is we're looking at something of not much substance. There's an easy fix for that, right? We have hopes for these companies. We think they will grow. What if we take revenues 10 years from now? Take your own DCF. If you have a small company that's growing, look at your projected revenues 10 years from now. Much bigger. In fact, most of you, all of you who value young money-losing companies, you're making money by the time you get to year 10. What if you could take the price today and scale it to revenues 10 years from now? It's called a forward multiple. A lot of analysts in sectors with young companies, instead of taking price to earnings now, will take price to earnings 10 years from now. The convenience is now you're getting positive numbers even for young money-losing companies. You can use something of substance. The downside is you have to be careful, because what you get as your forward price there's a lot of pain before you get there. So let me show you what I mean with it. It's about 10 years ago, 2013, was my second valuation of Tesla. I did a valuation of Tesla and a terminal value of 68 billion. That was almost 3 times larger than the actual value then. A lot of people latched on to that and say, you must like Tesla. Look, the terminal value is 3 times higher than the value today. And I actually did a post on why the terminal value is a very misleading number to focus on. First, in my discounted cash flow valuation, when do you get the terminal value? 10 years from now. So what's the first thing you have to do if you're going to compare to the value today? You got to discount it back. Forget about risk. First thing I did is, even if I discount back at the risk-free rate, I'm going to lose about, from 68, that's about 16 billion gone. But remember, the terminal value is not risk-free. If I discount back at the risk-adjusted cost of capital, that 52 billion. So just by discounting, my 69 billion becomes 27 billion. But I'm not quite done. If you think about what you had to go through to get to the terminal value, cash flows in year 1, year 2, year 3, year 4. Remember, it's a young, money-losing growth company. So what do those cash flows look like in the early years? Big negative cash flows, right? We talked about this as a dilution effect. I said, if you bring those negative cash flows in, the 28 billion becomes 12.8 billion. Look how quickly we've gone from 68 billion to 12.8 billion. And then you add options and other layers. By the time you're all done, you're down to 8 billion. What I'm trying to say is a lot of companies will look cheap on these forward multiples. But be very careful what you're paying for, because you might be overpaying by missing everything you need to get through to get to that forward value. So we've looked at looking at proxies that drive your sector. We looked at using forward numbers. We try one final attempt at what to do with young companies that are difficult to price. In 2013, Twitter went public. Actually, the discounted cash flow valuation 4 weeks before it went public. And you could probably find it on my blog. I came up with the value $18 per share, with a big story for Tesla. Oh, sorry, for Twitter. So after I finished my DCF valuation, I said, you know what? The IPO market is a pricing market. People don't do discounted cash flow valuation to price the company. I'd like to price test at Twitter. And to price Twitter, what do I need to find? Other companies like Twitter, right? And in 2013, I went and collected social media companies that got their revenues from advertising. I threw a Netflix in there as a subscription company because it was one of the few companies out there that was online, publicly traded. The market cap of each company. I computed the enterprise value for each company. So those were pretty straightforward. And then I said, collected all the standard financial metrics that people scale things to: revenues, operating income, EBITDA. What was I trying to figure out? I was trying to figure out what is the market pricing these companies on? Why are some companies priced higher and lower? And I just want to see, is it revenues? Is it difference in operating income? Is it difference in, and I, just as a lark, I threw in the number of users that each of these companies had. Now, if you're trying to figure out what the market is pricing in, you have a bunch of variables. How do you decide what the market is focused on? How do you know what the market is pricing in? Statistically, what am I looking for? I'm looking for something correlated with price, right? The higher the correlation, the more the market is focusing on that here. So that's what I did. I ran a correlation of market cap against all these variables, revenue. And guess which one came out as my standout variable? The number of users was the strongest predictor of what your market cap is. It wasn't revenues. It wasn't how much money you were making or losing. It's the number of users. You're saying that doesn't make sense. Hey, what you think makes sense and what I think makes sense doesn't matter. It's what the market is pricing in. The more users you had, the higher your market cap. And roughly speaking, the market was attaching a price of about $100 to a user. Remember, my job is to price Twitter, right? So what do I need to do to price Twitter? If I know the market is pricing a user at $100, what's the only number you need for Twitter to come up with the pricing? How many users did it have? And in 2013, it had 240 million users. You don't even need a calculator or a computer, right? You want to price Twitter, what do? You take an envelope, you turn it over. Why? I don't know why you always write in the back of the envelope. You could always write in the front as well, right? The white on both sides. Probably take front or back. Take 240, multiply by 100. What do you get? $24 billion, which works out to about $45 per share. And this might be pure coincidence, but go back and look at what Twitter opened at on its first day of trading. It's around $45 per share. Think of how much time and energy we spend going through a DCF. We say, my job is pricing this. And this is my problem with bankers. If you're a banker, what's your job? If I'm Twitter, I come to you and say, I need to go public. Your job is to price my company, right? So what you do is you take an envelope, you write 240 times 10 is 2,400. You put it in the top drawer and say, but it won't look good if I tell people that's what I did. So what's the next thing you do? You turn to your underlings, usually you guys who'll be hired next year, and say, you know what? I want you to work on a discounted cash flow model. Make it a 3-statement forecast. More detail is better, but there's one constraint, which is your model has to deliver roughly $45 per share. What an insane waste of time and intellectual resources. I am horrified by what bankers spend their days on. But I understand if you want to work 20 hours a day and it's actually delivering something productive, I'm all on your side. This is not the hard work, is its own reward. But this is pointless work, right? You knew that the value was roughly $45. Why are you making me go through 6 weeks of 20 hours a day? I lose sleep every day. I'm a nervous breakdown. I being the low man in the totem pole. And the managing director says, oh, it's for $45 per share. It's time for some openness and honesty in this process. Your job is pricing. Do a good pricing. If you want to tweak that value price per user, add more data, all the more power to you. Why are you wasting your time with a 3-statement forecast for the next 20 years when it's playing absolutely no role in how you come up with a number? So I'm going to close this pricing section by expanding my search. Let me explain. Up till now, everything that I priced against a sector, right? That's the way we're all taught to do pricing. But there's nothing about pricing that says I have to price it against a sector. What if I could price it against the entire market? What do you lose? Now you have companies in different businesses with different risks. What do you gain? A much bigger sample. This is a statistical game. Larger samples almost always trump smaller samples. So I think I started doing this about 30 years ago. At the start of every year, you've gone to my website, you've seen the data that I collect. But one of the things I do towards the very end, so it's a 1-week process that I spend the first week every year. The last day, what I do is I take the different multiples, PE, price to book, EV to EBITDA, I compute them for every company. And then I try to run market-wide regressions of PE ratios. Against what? Against the variables that I know should matter based on the analytics. Price earnings, remember, is driven by beta, growth, and risk. Price to book, beta, growth, and risk, and return equity. So I'll show you what that part of the analysis looked like at the start of 2022. I wanted to explain differences in PE ratios across US stocks. There's 7,200 companies in my sample. I lost about 2/3 of them. Remind me again why? Because their earnings were negative. I threw them out. I had 28, so I had enough companies still left. And I know, at least in conventional wisdom, growth is the key variable, the companion variable for PE. So I started by graphing out, doing a scatterplot of price earning against growth. And it terrified me. This is not going to be a great looking regression because your strongest variable looks like this. I know what kind of R-squared I should expect to see in this regression. It's not going to be 80%. It's not going to be 70%. It's not going to be even 40%. It's 5%. You see, that's awful. It is what it is. Remember, my weapon of choice was DCF. You said, let's do some pricing. You pick PE ratios, and I'm holding up a mirror and saying, really? You want to use PE ratios? They're almost impossible to explain at the start of 2022. For some perspective, that is the lowest R-squared I've had for a PE ratio regression going back 30 years. So you're saying, what is it about 2022 numbers that's making the PE? What's in the denominator? Earnings per share, right? At the start of 2022, earnings per share for most companies were trailing 12-month earnings, which would be earnings from either June of 2020 to June of 2021 for some companies, or September 2020 to September 2021. You see what's happening, right? 2020 demolished earnings at most companies. And many people, when they were pricing companies, you can't price Marriott based on trailing 12-month earnings because it was an awful year. You're seeing a reflection of the damage that COVID has done to earnings per share. But don't blame me. The problem is you picked a multiple based on earnings per share. It is going to be really difficult to use PE ratios for your companies if you're using trailing 12-month numbers. That will pass. I'll wager, and I'll make a prediction that next year when I run this regression, that R-squared is going to be back up to the 30 to 35% I usually see, but it's never going to be 90%. 3 variables, beta, payout, and growth. I told you why I picked those, right? I picked those because they showed up when I did the PE ratio equation with the DCF model. This is not a kitchen sink regression. What's a kitchen sink regression? You've all been guilty of this in statistics classes, right? When you're given a regression exercise, what's your mission? Maximize R-squared. How do you do that? By adding anything to the right-hand side that will push up your R-squared. That's not my game here. So I'm going to stick with the variables that I think should matter. Beta group. Let's make sure the coefficients actually make sense. Higher beta stocks have lower PE ratios. Make sense? Higher risk, yeah, that makes sense. Higher growth stocks have higher PE ratios. Again, makes sense. And higher payout ratio stocks, holding all its constant, have the signs of the coefficients all make sense. You're saying, shouldn't that always be the case? I'm going to talk about why it might not be, but at least in this case, they do. But this is almost a miracle. The R squared is 5%, right? It's a terrible regression. But take a look at the T statistics. They're all statistically significant. You say, how can that be? How can you have an R squared with such a low R squared and T statistics still be significant? It is the law of large numbers. If you have a big enough sample, you can end up with low R squareds and high T statistics because there is a statistical relationship still there. It's just the predictions are going to have a lot more noise to them. So multiple regression, again, it's not the answer to every problem. It's kind of a starting point for analyzing what's driving the market. So it's time for some statistical, I don't even know what the right word to use is, recovery of memories from your statistic class, let's call it that. I've been pretty cavalier about using multiple regressions, right? So let me go back and give some background here, which might lead you to question whether multiple regressions work. First, when I run a multiple regression, I'm assuming a linear relationship between my dependent variable and my independent variable. You're saying, what does that even mean? When growth doubles, P has to roughly double. Otherwise, you can't use a linear regression. I'm assuming linear relationship. Second, if I'm running a regression, I'm assuming stationarity, which means that if I ran a regression on January 1st, 2022, that it will stay usable for the rest of the year. Now, most years you could probably say what can change, but this year you can already see that things can change, just like in 2020, right? February 14th, COVID hits. So that's a stationarity assumption. And the third is a word that I heard in my statistics class that I would confess when I heard it, I said, cares? Why do you guys talk about stuff like this? It's the word multicollinearity. Does anybody want to tell me what multicollinearity is and why it's an issue? When you run a multiple regression in particular, this becomes an issue. What is multicollinearity and why is it an issue? Yep.
It's when one of the independent variables changes along with one of the other independent variables, so scaling them.
In a perfect multiple regression, what has to be true about the independent variables? They have to be uncorrelated with each other. What are the three independent variables I have? Beta, growth, and risk. There is not a snowball's chance in hell that they're uncorrelated with each other, right? Think about it. If I have a stock with high growth, what kind of payout ratio would I expect to see for that stock? Probably a really low payout ratio and often high risk, right? These things are kind of twinned at the hip. In fact, I would argue in finance, it's almost impossible to find three variables out of a company that are not connected to each other. I'm probably violating every single rule in the multiple regression textbook when I'm doing this. But I'm going to keep going and talk a little bit about how I dealt with this. So let's start with some statistical cleaning up. As I said, I've run this regression every year for the last 30 years. And once in a while, you will get variables that you think should matter, but are statistically insignificant. Remember beta, growth, and risk. They should matter from a theory standpoint, but the market doesn't always cooperate. In at least 3 of the last 30 years, one of the variables out of the 3 has been statistically insignificant. I look at it, it bothers me that it doesn't belong there because it makes my story much weaker. Then I say, you know what? I'm pricing companies. I have to bow to the data and I take that variable up. Don't fight the data again. So when you run a regression, you say, this should matter, take the should out of the conversation because this is what the data is telling you to do. Leaving statistically insignificant variables in your regression basically adds noise to your predictions. It doesn't help you in the R squared. It actually makes your predictions worse. So take that. The second is, when I run a regression, you get that intercept, right? That intercept sometimes can be negative. What it basically means, if you draw the line through the points, the line crosses below 0 rather than above it. You're saying, who cares? It creates a practical problem. You're using this regression to make predictions, as I'm going to use to get a predicted PE for a company. If you start with a negative intercept, you start plugging numbers in, your predicted PE for a company can actually be negative, which actually is kind of meaningless, right? PE ratio should be higher than 0. Saying, what choice do I have? There's a little trick. Almost every regression package allows you to do it, which is it allows you to make the constant 0. In other words, it allows you to force the line through 0 rather than where it crosses. It's not a great idea because your line is no longer the best fit line because you took the best fit line and you tweaked it, but it removes this problem of a negative intercept. So if your intercept is negative and it's getting in the way of your predictions, go back to the regression and force it through 0. And finally, let's talk about the multicollinearity problem. I took the start of 2022, I took beta growth and payout, and I ran a correlation matrix. Basically, it looks at the correlation between every pair. I'll tell you what these numbers should look like in a perfect regression. See all these numbers that are off the diagonal will always be 1. The variable is always perfectly correlated with itself. But all the variables that are off the 1 should be zeros. Basically, those correlations should be 0 in a perfect. In this case, you can already see the data is flashing red lights. High growth companies have higher risk. High growth companies have lower payout ratios. Exactly what you should expect to see. But there is multicollinearity in here. Now, if this were a statistics class, you'd be told, throw the regression out. But if we threw out every regression with multicollinearity in finance, we would never be able to run a regression. But here's the good news. Even if you have multicollinearity, you can still use regression, but here's what's going to happen that might cause some angst when you run the regression. Remember we said higher beta stocks should have lower P ratios, at least in theory, higher risk stocks. Out of the 30 years that I've run this regression, in about 10 of the 30 years, beta has had the wrong sign. In other words, instead of having a negative sign, it's had a positive sign. Your first reaction is, that's weird. Why would higher risk stocks have higher PE ratios? You see what's happening? What does a computer see when you give it this data? You might call it beta growth. It just sees 4 columns of numbers, right? Let's say all your high growth companies tend to have high betas. You know what's going to happen? After a while, the computer gets really confused. Is that number standing in for? It doesn't know what it's growth. So after a while, beta becomes a proxy for growth rather than a proxy for risk. So if you run a regression, you see the wrong sign on a coefficient, for God's sakes, don't try to fix it by just changing the sign. It's a reflection of the fact that there's multicollinearity. Just let it ride. The overall regression can still be used for predictions, but don't read too much into the individual coefficients. But here's the bottom line. I want to run this regression because I want to price companies. You're saying, well, how am I going to use it? Let's suppose I came to you with Disney, start of 2022. I gave you its growth rate, its beta, and its payout ratio, and you plugged it into the regression. You get a predicted PE for Disney of 35.84. So based on the 2022 regression and Disney's numbers, my predicted PE is 35.84. Of course, with the R squared of 5%, the range on my prediction is going to be wide. In fact, most statistics package will even give you that range. And I think the range I get is somewhere between 30 and 42. So why is it so big? Because the R squared is 5%. The advantage of having a higher, it's that Disney was actually trading at 38 times earnings. So what would I learn from this regression? It looks slightly overvalued, but once I bring in the noise, I'm going to say it's a fairly valued stock. Then I do the next stock and the next one. You think this is such a waste of time. I have 7,200 stocks I can work through, right? Even with this noise, I'm probably going to find 20 stocks that fall outside the range as being too cheap, and 20 stocks that are going to fall outside the range in the other direction is too expensive. Let's say I want to start a hedge fund. This is regression. What am I going to do? I'm going to buy the 20 cheap stocks. I'm going to sell the 20 most expensive stocks and get down on my knees and hope and pray what happens, that they move back towards the regression line. That might never happen. But you heard of quant investing, right? You wonder, what the heck is it? Think of what I just did and put it on steroids. So my data was annual data from S&P Capital IQ, but now you can actually get much richer data, intraday data, trading volume data. So they start with richer and bigger databases, big data. I used a multiple regression, this most simplest regression technique I could want, because this wasn't a statistics class, but they hire MIT math and science guys, and that's probably why they do it. is the skill here you need is statistical skills. You bring in the most powerful statistical tools in big data. You can build something much better than a simple, at least you hope. And then you do what I just did, buy the cheapest and expensive based on that model. But remember, your potential for creating returns run is only as good as your model. And even with the very best quant models, the noise you have in this process is so immense that I'm skeptical whenever I hear a quant fund say, I've found a way to make money. Remember Jim Simon? Some of you might have read the book about Jim Simon. He's one of the first quant guys to hit Wall Street, 1988. He hired, again, math and physics and science PhDs around him. And he's a pure quant guy. And he made a ton of money. He's legendary from 1988 to about 2015, because he was one of the few people using big data before there was big data and quant approach. Now, there are probably 50 different quant funds. And Jim Simon basically said, hey, the best days are behind us. So something to think about when you hear about quant funds and what they do. One final thing about this regression, remember that coefficient on growth, 0.45? Think of that as the price that the market is willing to pay for growth. And I've kept track of that number through time. So the red line is what the market is paying for growth. That's a good thing, right? Higher growth, higher. You're saying what's a brown column? That's the equity, the implied equity risk premium at the start of the year. That measures the price of risk, which is the bad thing. So the market is attaching a price to risk and lowering your price, and attaching a price to growth and pushing up your price. If you're a high growth, high risk company, 2000 was nirvana for you. You see why? The price of growth was high, the market was rewarding for growth, and the price of risk was low. So you were not being punished for being risky, and you're being rewarded for growth. Of course, that didn't last long, you had the correction. But by tracking these two numbers, I can tell you what a typical high growth, high risk company is going to be facing at different points in time. At the start of 2022, price of growth has dropped. Growth is not being valued as much as it was because everybody is growing. You know why? Because even companies like Marriott are growing. Your base year is 2020. You're going to be growing for a while because you're coming out of COVID. Growth has become not a scarcity, but everybody has it. Will that pass? Yes. By 2023, 2024, I expect it to go away. But that's a good number to track as you go through time. One final big market regression. PEG ratios, we talked about them last week. I want to run a regression of PEG ratios, and the conventional wisdom is I have to worry about growth. So I did PEG ratios against growth. And I said, I have a problem. You see what the problem is? If I try to fit a line through those points, I know it's like, it looks like the line should go like this, right? So I'm going to give away a trick. And don't try to tell this to your statistics professor, you beat me up because they think this is sloppy. Whenever I have a non-linear relationship like this, my fix is to take the natural log of the growth, of whatever the variable that's causing it. You know, the small ln on your calculator? It's like magic. I did the natural. Hey, that looks a lot more linear, doesn't it? Same data with log of growth. I'm moving on. There are 100 different adjustments in statistics. The remaining 99, I think, is pure crap that statistics professors make up to add some noise to this process. Just take the natural log. It works 99% of the time. The other 1%, who cares? And when I ran the regression of PEG ratios, notice that what's different is instead of beta payout, there's log growth. So if you have something that's non-linear, check that because you can see it in the scatter plot. Fix it by taking the natural log and move on. You're going to be okay. So I'm going to close with, I'm not going to hit the entire series here, but start of every year, I run this regression for US stocks. I used to run it just for US. Now, because I have global stocks in my data set, I run it for global stocks. So I run it for the US, I run it for all stocks globally, 46,000. And I break down by region. Why? Because if you came to me with an emerging market company and say, is this cheap or expensive relative to the market? I might be better off putting it into the emerging market regression. Notice the R-squareds vary across markets. Why? Because, you know, and there's no pattern to this. Not like the same regions have higher. At the start of 2022, I had a better shot with Australian, New Zealand, and Canadian companies because they're commodity companies than with US companies to PE ratios. Different. The coefficients obviously vary across the country, but it's the same three variables. Yesterday, I got an email from somebody in India watching my YouTube, and he said, I like your videos, but could you do an Indian version of a valuation class? And I said, what exactly would be an Indian version? You think you're under some special set of rules that I'm going to throw in a fourth variable that's a karma variable that explains away PE ratios? Okay? But it's the absurdity of believing that every market is unique. And these regressions kind of bring this home. So I do this for PE ratios, then I do it for price to book, so I won't bore you with each of them. But notice the variables that pop up will always be the variables that we talked about. As for price to book, you'll see return on equity. When you see EV to EBITDA, you're going to see the tax rate. With EV to sales, you're going to see margin. So basically, I'm doing what we did in the, with by region and globally. I'll send you the link for all of these so you don't have to read them off the PowerPoint. But basically, my end game is no matter where you are in the world, I should be able to attach a pricing to you, given the multiple you pick and given the region of the world you're in. So at the last part of your project, I ask you to price your company against the market. All I'm asking you to do is go to these pages, find the region that best fits your company, plug the numbers for your company into that regression, and tell me based on what the market is doing, what kind of pricing you'd attach to the company. So I'm going to close with a couple of things. One is some choices you'll have to make. So as you sit there, assuming you haven't started the pricing, the first choice you have to make is, are you going to scale to equity value or enterprise value? If you have financial service companies, that choice is out of your hands. It always has to be equity value. But for regular companies, one of the things that drives it, if you have big differences in leverage across companies, go with an enterprise value model. You got to pick a scale up. Are you going to scale it to revenues, earnings, book value? And again, the choice might be taken out of your hands. You have a lot of money losing companies. Guess what? You're going to use a revenue multiple because you want to make sure you don't end up losing half the companies in your sample. Then you got to decide whether you want to take 2020 numbers or 2021 numbers, whether you want to use forward numbers, whether you're going to, hey, I am agnostic. Pick whatever gives you the biggest sample, which you think is the best way to think about pricing, but make it the same choice for every company. And finally, you got to come up with comparables. And you got to decide geographically whether you want to stay with your domestic market, which for the US might be entirely feasible. But if you're doing a Slovenian company, it's not going to work. There aren't enough companies. How are you going to expand it? All European companies, all global companies? Are you going to put in other constraints on company size? Again, I'm completely agnostic, but keep in mind that whatever you do, you don't want to end up with a sample size that's too small. So I'm going to leave you with two propositions about pricing. The first is, in a pricing, you tell me something is cheap. You're making a conditional statement. You're saying it is cheap, given these other companies I compared it to. So keep that in mind whenever you make a statement about pricing. Second, no matter how hard you try, there is no company that's going to be just like your company. You have to find a way to control for differences. I used a lot of statistics, but that's because you don't really need to know how to run a regression. You need to know how to read a regression. Use that power that you have now that you couldn't have done 30 years ago. So I'll leave you with the 4 steps for understanding multiples. Start by defining consistency, uniformity. Defining, and then describe it. Do Moneyball, look at the histogram. Analyze, do the little algebra trick we did on equity multiples DCF model. And only then apply. If you do that, you're going to be a much better price. So pricing should be relatively straightforward. If you have some time this weekend, you want to get it done, because next weekend you're going to be preparing for right? The third quiz is coming up right after. So this is your open weekend for valuation. Of course, your other classes are there, but who really cares about your other classes? Just get rid of it anyway. It's such a waste of time. So just get this class done. And we'll go into the grade books and change the grades of all your other classes to make them. So I will see you on Monday.
I